Sanjeev Prasad joins us now, and I just want to read the language. Sanjeev, I'm coming to you. ICICI Bank clarification. Information on CEO is a figment of imagination. We would like to categorically deny information published in the article regarding ICICI Bank MD's departure. I mean, this came before the market bell and it has been doused immediately after the market bell. The stock should have reacted, I'm sure, by now. There you go. It's come on exchanges, 1151. Sanjeev Prasad, good morning. Thank you for joining us. The bull run continues. And the bull run in small and mid cap stocks also continues. It's amazing, right? I mean, it's amazing that how markets are climbing the wall of worry.
What's the worry you're talking about? Because there is really no worry in the market. Everything is pretty decent as far as India is concerned, right? Macroeconomic position is pretty decent. Most of the macroeconomic parameters are fine, are moving in the right direction. There is no leverage issue, in the country. Banks, companies, households, all are in pretty great shape. I would assume there is not much of a political slash social, negative surprise over there, right? So as far as India is concerned, I don't know. Everything looks pretty good. Earning numbers have been decent, somewhat disappointing here and there a little bit, but broadly speaking, nothing to really concerned about India on a fundamental basis. I mean, valuations are what they are, but I don't think there is a cause of concern. I would say, if anything, I would be a bit worried that people are not absolutely not worried about anything as of now.
I say the macro environment. When I say worry, the macro environment where interest rates could move, where geopolitical tensions are, where valuations are. In general, there has been a lot of opinion which has been floating around where and how world is moving.
That's okay. I think the global markets are reconciled to longer for higher inflation for sure, or I would say higher for longer interest rates more correctly. So if you look at the US Federal Fund futures rate now, they're discounting only one cut of 25 basis point in calendar 2024 versus 6 to 7 at the end of 2023. And you can see the reaction in the US markets. Beyond that, I don't know. China continues to do actually quite okay compared to earlier expectations. The first quarter numbers have been reasonably positive. Europe is starting to show some signs of recovery. So broadly speaking, beyond the interest rate issue, I don't think there is any real, geopolitical issues always there. Hopefully they don't, become any bigger than what they are. But if they are contained, I don't see that much of a concern, I would say, for the markets, beyond valuation.
In this kind of an environment where India is now part of top 5, perhaps the only place where growth is decent and predictability is decent, foreign institutional investors, they continue to reduce their exposure to India. The data what we've got, at least for YTD and at least for the month of April, seems to be pointing out that foreigners are selling into India. They're booking profits. Do you think this trend will continue? It's a matter of, do you think this trend will continue, or post-election it could change?
I think it's got much to do with India, I would say. The problem for emerging markets is for some of the foreign portfolio investors are that, they are part of a broader emerging market portfolio managers, right? And the bigger issue for India, not so much India by itself, but what is happening to emerging markets. If you look at the performance of emerging markets in the last, whatever period we take, 1, 3, 5, 10 years, it's been absolutely disastrous. I mean, the last 10 years, MSCI emerging market index is pretty much flat, actually. I mean, all thanks to China and a few other emerging markets. But because of that, you are not seeing any real money coming into emerging markets. And if you compare that with how the US has done by itself, I mean, S&P is up about 100%, over the last 10 years. So, you're not seeing much of money coming to emerging markets. So that's the first problem. Second problem is that within emerging markets, a lot of investors got the China-India allocation absolutely wrong. And that was more towards the end of calendar 2022, early part of 2023, where a lot of investors bet positively on China reopening trade. And we are concerned about valuation in India. But what really played out was China kept on getting cheaper and cheaper, and India kept on becoming more and more expensive. And now you've reached a stage where you can't sell China because it is just too cheap. And maybe foreign investors believe that you can't enter India at this point in time because it looks too expensive. And the third problem for emerging market investors has been that they have got I would say within India, they've also got the market cap and the stock selection wrong to some extent. I'm talking all with the benefit of hindsight. So if you see what has performed is the non-FPI stocks, I would say. All the investment related stocks, many of the PSUs, mid cap, small caps. Whereas the foreign portfolio investors are largely in private banks, consumer, IT, etc., which have been, underperformers. So it's been a triple whammy as far as foreign portfolio investors are concerned. I'm talking about the long only emerging market type money.
There are two curious case reports from Kotak Institutional Equities. Curious case of Indian electricity sector, curious case of Indian cement sector. Which one should we discuss? Because they both look interesting.
Whatever you want to discuss, happy to talk about.
Okay, let's first understand power. That's where the excitement is. You are of the view, or your firm is of the view, that there is a glut in solar module prices. I'm breaking it for our viewers. Solar module prices have come down by 75 to even 90%, which means the cost of producing energy by the solar route is going to be cheaper. That means thermal, which is koila. The cost of producing from the thermal route would be expensive. So the excitement in some of the thermal related sectors should come down. Am I right when I introduce this curious case?
Broadly speaking, see, obviously in the short term, you have a situation where you could see some amount of electricity shortage. And that's what the market is focused on. That's what the market is excited about. Our view is that, look, anyway, valuations, of any stock is based on the cash flows of the next several years, the next 2 decades, or even more in some cases, right? So the big issue is now if you have solar, PV module prices which have just collapsed, solar PV tariffs are, or rather solar electricity tariffs are anyway far lower than thermal electricity tariffs, and that will probably continue for the next few years. Really have a thrust on moving to renewables as far as the government of India policy is concerned. You want to reduce carbon emissions, etc., etc. So in that context, over time, the mix as far as India's electricity sector is concerned will keep on moving towards solar and less towards coal. So what is the excitement about coal or coal-based thermal electricity generation in the medium term or long term? Anyway, I don't think many of these assets have any real value. I simply cannot fathom. And if you do any sort of reverse valuation exercise for any of the solar electricity company generation companies, I'm sorry, any of the thermal electricity generation companies or the thermal equipment companies, absolutely make no sense, and I can get into details, if anybody's interested, but, just factoring, as if India is going to put up at least, I mean, if you look at NTPC's reverse valuation, it is factoring in something like 50 to 60 gigawatts of incremental thermal capacity additions in the next 4 or 5 years. If you look at BHEL's reverse valuation, God knows how much of thermal capacity addition it is, the current market cap is pricing in. I mean, that really makes no sense. Yes, there is a shortage. We need to add more capacity on thermal, I guess, to bridge the short-term gap. But that is not the real story. The real story is India has to move towards renewables over a period of time. And the market has to start recognizing that and start factoring in, some of the medium-term and longer-term challenges for some of these coal-based either generation companies or the equipment companies.
Okay, now cement. Your view on cement also seems to be indicating that in the near term, cement stocks are pricing in a lot of growth and recovery, which in a sense cannot be justified with the ground reality.
No, that's not. Yes, cement volumes will be fine. See, I don't know what valuation methodology, honestly, people follow these days. I mean, some of them that we need to go back to the basics, I would say. I mean, cement is a sector which is a commodity sector. It's a very capital intensive sector. For every unit of new, volume to be produced by any cement company, you will have to add new capacity. It's as simple as that. And if you look at the fixed asset turnover ratio of a cement plant, it is probably going to be one time. For a brownfield asset, it's going to be less than one time for a greenfield, plant. So if you do a simple DCF exercise, which basically factors in the basic point that for every incremental unit of volume, you need to put in a lot of capex. Your P's cannot be high. It's a very simple point of life. If a fixed asset turnover ratio is low, your P's are not going to be high unless until build some ridiculous assumptions on profitability etc. So, which is where we struggle with, if I do any bottom-up valuation exercise, we struggle to get a PE of more than 15, 20 for any of such companies, I would say, where you have an asset turnover ratio of, one or lower. So it's a simple, valuation thing, which I guess people have forgotten, maybe in the excitement in the market, it's too much euphoria, I guess. So why bother about fundamentals, I guess.
Great to have you on the show. Thank you so much for taking the time out and join in right now. Quick look at what the market is up to.
If you like this video, then like, share and subscribe to ET Now.